And welcome to Weekly Profit Talk. Just like the name says, we are here every single week at 8:30 Mountain Time. That is 7:30 on the West Coast and 10:30 here in Scotia, South Carolina. We are live and on the road and mobile headquarters. We'll be coming to you from the road for the next couple of weeks. And today we are about an hour and a half away from Hilton Head. So looking forward to a little visit down there. So let's jump right into the topic for today, and that is what your 2024 return reveals about your practice finances. We just completed tax filing, obviously, a week and a half ago, and your tax return is a diagnostic tool. And let's go ahead and talk a little bit about that today. We'll kind of keep this short because we're dying to get back on the road. Oh, and the other thing, too, of course, accounting videos are so exciting. I really want to keep everybody engaged here as much as possible. So, um, whether or not you're filing a Schedule C and attaching that to your 1040, or you have a business return such as partnership or S corporation, you've got a valuable diagnostic tool at your hands. Basically, it is a measure of your business metrics, your margins. Um, Margin is simply a percentage of your revenue to your income. It's not what you make, it's what you keep. You'll notice here that I said if your overheads are over 60% of your gross revenue, you might have a little bit of a problem overspending. Now, I understand that a successful medical practice is definitely going to have high overheads in good quality staffing, and that's a necessity, a very necessary and ordinary expense. But this is one of those things where you can pull this tool out, your tax return, look it over, and look for potential problem signs. I've mentioned something here about depreciation. Now, your tax return schedule for depreciation is called the Form 4562. It's terribly cryptic looking. Basically tells the IRS what you're writing off, how much depreciation basis you have in the asset remaining. But any decent tax software, whether or not you did it yourself or you had a professional help you, should have some kind of a depreciation schedule, and it should tell you how much depreciation you've taken on your asset, what your depreciation method is, and that's going to be something like double declining balance. It might say M, that stands for makers. I think that's modified adjusted cost reduction system. Whatever it is, it's basically 200% or double declining balance. So in the first year, you're writing off more, and then subsequent years, that goes down. And that makes sense because the value of your assets going down too. So, but you might be using straight line. And the method that you use for depreciation is very important. Once you have something in service, because you're able to look at, and hopefully you're getting another schedule uh, with your depreciation schedules that shows you next year's depreciation. You can actually take that to the bank other than anything that you might buy during 2025. So that's important information to have. Review your deductions. Now, this is kind of a no-duh, but there are things on your profit and loss statement that appear um, on your tax return that might have you scratching your head. You're wondering what's going on. And I can tell you an example from my own practice, and certainly you're going to have this in any 21st century entrepreneurial endeavor. Software as a service, or SaaS for short. It is very easy to sign up for subscriptions and have software that's in the background, and you're paying for it monthly, but all of a sudden it's obsolete and your staff's not using it anymore. It pays to audit at a minimum quarterly, and monthly wouldn't hurt. Now, we've talked about that in previous videos as well. You want to be writing off everything legitimately possible, obviously. And the filter that you drop over that is ordinary and necessary. That is an IRS phrase, okay? And it just means that if you are spending money and it is ordinary and necessary to the conducting of your business, then it is legitimate write-off. So one of the things that is a really good example is, let's say you go into a business development coaching, but it doesn't have anything to do with medical advancement or expansion of your knowledge. That's okay. That's still an education expense. And again, you just need to make sure that you're getting all that stuff down. Non-commuting vehicle travel. Let me talk about that briefly. If you leasing an office, when you drive from home to that office, that's a commute. You cannot write that off, okay, even if you're in business for yourself. But if you go, say, from that office to a hospital or even in the field to see patients, another thing is travel. Let's say that you get paid to speak or seminars, that kind of thing. That is certainly all legitimate and ordinary necessary expenses. So, and of course, don't forget that all the stuff that you have to read and know, and as well as your continuing education, is certainly also legitimate expenses. And you need to make sure that you're getting everything down because the more expenses you have, the smaller your net income, the less your net income. Guess what? The lower your tax. Very simple. So there's a thing called effective tax rate. I'll tell you something else about that software. You should have a sheet called comparison. It'll be at the end of your federal stuff before your state filings, usually. And if you have used the same software at least 2 years, it'll show you side by side. But if you scroll down to the bottom of that comparison sheet, you're going to have something called effective tax rate. If you don't have a comparison sheet, no sweat. All you got to do is go to your 1040. The bottom line of page one's got something called taxable income. That's after your standard deduction or itemized deductions plus your qualified business income deduction. That's the number that actually comes off the tax table. If you divide that number into the next line, tax, you'll get a percentage, and that's your effective tax rate. Physicians, you should be somewhere, I'm saying, between, if you're new in practice, maybe 18%, but probably more like 20 to 30%. If you are basically paying the maximum effective tax rate, you might not be taking advantage of the best strategies, as it says here. If your effective tax rate is extremely low, then before you flex, think about whether or not you're actually writing off some stuff that, in fact, you shouldn't be. So I have an example from my past. We were working with real estate investors for some period of time, and I talked to a guy who says, yeah, I write off my haircuts. I was like, well, do you wear that head when you go out in public? And the answer was, of course, yes, you do. It's got to be specific to your business. Same thing with your clothes. You can't write off clothes unless it's something that you cannot wear anywhere else. Now, your white lab coats, that's a write-off because that's basically not something that you're going to wear into the bar after work. So you see what I'm saying there, right? So red flags and warning signs, dramatic year-over-year fluctuations. If your margin graph looks like an oscilloscope, or like the crazy financial results that we're getting lately on the markets, that could be a danger sign, actually, unless you have the kind of practice where you have seasonal fluctuation in your revenues, of course. But it's a thing to watch for. And deduction ratios, significantly outside industry norms. It's easy enough to look this stuff up, by the way. So one thing perhaps you want to take a look at certainly is your staffing, and make sure, and we've talked about this in past weekly profit talks as well. One of the things you can do, as long as you don't have a crossover for internal controls, is actually make sure that some of your staff is cross-trained on some of the things that some of your other people do, so that you've got good coverage available to you. Say somebody wants to take a 1 or 2 week vacation. So it's important for that reason. But also, if you've got people that can back up other people, then you basically are getting very effective use from your staff. And would be looking at staffing ratios with a critical eye. And I think that's worth monthly review, personally. Consistently thin profit margins despite healthy revenue. That, of course, it just kind of goes without saying. If your bottom line is under 20%, despite the fact that you don't really have any more than the normal complaints about your claims receivables, then that's something to take a look at. Unexplained discrepancies between business and personal returns is another one. And that's something, I guess, when I wrote that down, well, basically, we here at Owings LLC endeavor to file taxes for the personal lives of our chief clients because the business that you're doing feeds straight into your personal life. And if you have, say, business results that are significantly better or significantly worse than the amount of money that you're actually filing in your income tax, there are several things that you need to be keeping an eye out for. One thing is estimated tax payments. You may have to calculate those based not well. Let me take that back. You must calculate those based on all of your forms of income that don't have some sort of withholding. So let's say, for example, that you have elected S corporation, and that's a great idea if you're making over 100K net income, because if you take a reasonable compensation from your business, um, then the remainder of the net income beyond that is subject only to ordinary income tax. You don't have to pay FICA on every single dollar you make. If you're getting close to $500,000 in net income and you're still filing Schedule C, you're killing yourself and you need to get a hold of me. Okay. By the way, let me wrap up on that. We're coming to you in 3 different media. All 3 of them have some kind of comment section. We're on LinkedIn, YouTube, as well as, of course, Facebook. And if you comment help or more info or something like that, or you can just write me an email to Eric, ERIC, at owingsllc.com, or go to our website. There is a work with me link. Any one of those ways, we can have a quick first conversation, is what I call discovery. Learn about your business, see if we're a good fit for you, you're a good fit for us. That first conversation has no cost. And if you would like to learn more about how we take care of these things for our people all year long, make sure your estimated payments are fairly accurate and that you actually look forward to your tax season, and your next tax return should tell you about your practice finances without making you a nervous wreck or feeling like a trip to the dentist for a root canal. And that's because if you're paying your taxes correctly during your 4 estimated tax payment periods, then you should, in fact, owe less than $1,000 at tax time, and you actually look forward to tax season. And that's what I mean by that. So with that, if you have any questions, you know how to get a hold of us, we just mentioned. And we are here every single Wednesday. Next Wednesday, we're going to be probably in Virginia or Kentucky. I'll have to let you know. I'm sorry I didn't look it up before we started, but mobile headquarters continues down the road. And we are working our full schedule. So if you need anything at all, let us know. So until next week, have an amazing day, an awesome weekend. And if you get a chance, do something randomly kind for